co learners, and welcome to today's accounting lesson. My name is Mr. Cindy, and this lesson is brought to you by the Gauteng Department of Education in collaboration with the Sabono Discovery Center. We are going to be having these lessons, so it is important that you tell your friends that lessons are going to be starting, and then we need to have all the resources that we can use. Make sure you bring a calculator, you bring a pen, so that you can be able to write as well. In today's class, we're going to be focusing on the concept that relate to the statement of comprehensive income. In the previous week, we dealt with companies' concepts and ledger accounts. And then in today's class, we're going to be looking at the concepts on statement of comprehensive income, as well as the preparation of the statement of comprehensive income. So if you know that you have a challenge with adjustments, today's class is for you, all right? But what is very important is that you follow today's class. Make sure you are writing. Make sure you have your calculator, as I've said, and make sure you have your pencil so that you can be taking notes of what we will be doing. So to begin with, let's bring in some concepts that relate to the statement of comprehensive income. All right. So the statement of comprehensive income reflects the trading results in the form of profit or loss for a specific accounting period, which is usually a year. So when a business operates, one of the main aims is to generate a profit. And when a business generates the profit, it will need to show this profit. And the statement of comprehensive income therefore helps businesses to show how we have generated the profits. At year end, all income and expenses accounts will be checked to ensure that all figures represent the amounts for the current year. This is very important, that at the end of the year, we need to compare our income and expenses that we incurred in order for us to generate that particular income. And then when we do that, we then are able to calculate either our profits or our losses for that particular financial year. Adjustments will be done to rectify any accruals or prepayments. It is very important that you know how to do adjustments. I know most of you would say, I have a problem with adjustments. In these sessions, we're going to help you to make adjustments easy for you. And we're going to be looking at accruals or prepayments. If you're not sure what are accruals or what are prepayments, make sure you follow today's class, because we're going to break down all these accruals and the prepayments and how they must be recorded. Okay? And then the net income or net loss is obtained by subtracting expenses from the income. So it is very important that you know your income as well as your expenses so that you end up getting your income at the end of the year. The format of the statement of comprehensive income is of great importance, because when you know what to place where, it becomes easy for you when you prepare the statement of comprehensive income. And now we're coming from grade 11. In grade 11, we did the statement of comprehensive income as well, but we were doing it for what was known as the partnerships. You remember we did that in grade 11, the previous year. In this year, the format will remain almost the same. I'm going to show you in today's class what are the changes that would have occurred from the statement of comprehensive income that we did in partnership to the statement of comprehensive income that we need for our grade 12. So to begin with, I've broken down the statement of comprehensive income into about 3 parts. The first part is what I'll call my trading section. In my trading section, this is where I record my sales, and this is one of the most important aspects, your debtors allowances. You need not to forget to record these ones. So I will record my sales, and then I subtract my debtors allowances. Then here I have 100,000. Remember, we're just doing format right now. We're just doing format. And then I will subtract my cost of sales. So cost of sales is subtracted. Hence you see here, I put it in brackets. That would then give me what we call gross profit. Of course, you remember this. We did this in grade 10 as well as in grade 11. This should not be a problem for you at all. The second part of my statement of comprehensive income is what I call the operating section. So this is where I begin to show the operations that happen in the business and other certain things. In here, I will have my discount received, my rent income. You have your profit on sale of asset. So remember here, I'm recording my other income. What other income have we received in this financial year? We also have what is known as bad debts recovered. I will explain it in today's class. What are bad debts recovered? Provision for bad debts adjustment. This is a very interesting adjustment. And if you know you need help with this adjustment, please follow today's class. And then we have several other ones that will be considered. And then we end up with our operating profit. After that, we then come to what we call operating expenses. Operating expenses. This is where we have several expenses that a business will incur when it is in operation. We're going to take a quick 1-minute break. Please stay tuned. I'm going to see you in exactly 1 minute.
Excellence. Excellence is a habit. Excellence is a quality you have, a quality I have. It's a quality we have when we honor what is true to us. Yes, we are gifted differently. uNkulunkulu akasinganga ngokufana. Excellence is striving for your best. Whenever you have a particular project, test, homework, uzibuze, ask yourself, is this my best? Can I put in more effort? Excellence is striving to be in the top 1% of the area in which you are gifted. And so I challenge you, in every single thing that you do, in every single area that you're gifted in, whether it's sports, it's academic, ucula, whatever that gift is, strive for excellence.
Welcome back. We just took a 1-minute break and then I'm going to continue from where I had left off from. Remember, we're talking about operating expenses. And we have most of the expenses that we've seen in our grade 11 year. But I have a few new expenses, which is your audit fees. You're wondering, what is audit fees? These are fees that are paid to our auditors, our external auditors. And we also have what is known as directors' fees. Remember, we have people that are appointed by shareholders to do the day-to-day running of the business. And these are called directors. And their fees must be shown separately as directors' fees. So these are the new concepts or the new items that you will find in the statement of comprehensive income for this year. I'm going to show you one more, which is new as well. All right. Now, remember when we did the sole trader, that was in grade 10. All right. And then we did this part of the sole trader whereby after we have the operating profit, we just add interest income. And then after the interest income, we then get the profit before interest expense, which we subtract. Then we get net profit or loss for the year. Then we were done. We were done when we get to this point. That was in grade 10. But now that we're in grade 12, remember we are dealing with companies. We're dealing with companies, and need I remind you that the owners of the company are called what? Shareholders. Now that we are in grade 12, we will come again where we have our operating profit, and then we add interest income. Very important that interest income is added. So we add interest income. Then we get our profit before interest expense. Then we will subtract interest expense. Now, it will not end here as it was with the sole trader. We still have a bit more to go. We will now have what we call profit before tax. All right? Because if you follow in last week's class, we spoke about the company being a legal entity, which therefore means it is subject to paying tax according to the tax bracket that would have been issued by the Minister of Finance. So at times you find that in your question paper, your tax may be 28% or 30%. In this case, our taxation is at 28%. So after we have the profit before tax, we will then subtract our income tax, and then you get 28% of that figure, then you end up with that amount. And then we now have what we call net profit after tax. So this year, our statement of comprehensive income, it will assume the same structure, but we're going to add certain aspects onto it, such as audit fees. Another one, director's fees. What is the next one? Income tax. So once you know these aspects and you know where to place them, it becomes easy for you when you prepare your statement of comprehensive income. All right, let's continue. All right, we are going to do an activity now. We're going to begin with activity number one. Activity number one. So for this activity to make sense to you, make sure you are writing, okay? Because I'm going to do certain adjustments with you for you to be able to understand. Make sure you have a pen, you have a pencil, you have a calculator. Very important. How can you do accounting without a calculator? And you somewhere to write, okay? Then let's begin to do the first activity, which is activity number one. Let's go. This is for Egu Limited. Required. Complete the statement of comprehensive income for the year ended 28 February 2023. The company has an authorized share capital of 1 million ordinary shares. Okay, so this part is just there to tell us that we have this authorized share capital. However, it will not have an impact on our statement of comprehensive income, because remember, in our statement of comprehensive income, we need to record our income and then our expenses. All right, let's look. We are given a pre-adjustment trial balance. Okay, so this is a list of balances that we are given as at 28 February 2023. All right, you know what is going to come next? Adjustments. And then we have about 10 adjustments that we're going to do today. All right, so here are the adjustments. And for them to make sense to you, I'm going to break them one by one and I explain. Once you understand, you tell me, Mr. Simbi, I've understood. Then I'm going to move on to the next adjustment. Are we okay? Okay, let's do that then. So we're going to begin with the first adjustment. There it goes. Adjustment number one. So I'm going to give you time so that you can see the information and understand it, so that when I do the adjustment, it also makes sense to you. It says, we are given a pre-adjustment trial balance as of 28 February 2023. You can see here we have our sales, but we are not given our cost of sales. And then we're given what is known as debtors allowances. Adjustments. The business used a fixed markup of 60%. You know what is markup? Markup, it is that profit that the business will make in selling the goods to customers. All right, so the business will use a fixed markup of 60% on cost. This was achieved over the financial year. And on 28 February 2023, credit sales of 9.6 were not recorded. All right, so here we have two adjustments that we want to do. I'm going to show you how to do these adjustments. Let's now see if we're given the answer book. There is our answer book. Remember, we are always given the answer book in accounting. And whenever you are writing, you need to understand your answer book so that you'll be able to fill in the information. All right, so we know the first thing we have to write here is our sales. We're going to record our sales. So I'm going to come here. I hope you're writing with me. Okay, let's begin. So I start off with my sales, and I'm going to come here and say sales. Then I open my bracket because I am given here 1,770,400. So I'm going to take that and I bring it here, 1,770,400. I know that before I do anything, I need to record my debtors allowances. Debtors allowances. So the first thing I'm going to do, I'm going to come and say minus how much? 6,000 for the debtors allowances. Okay, so we have subtracted our debtors allowances in this case. All right, let's go on to the next aspect. On the next aspect, I am going to wait with adjustment number one. I know I'm going to use it. When I'm told you that the business uses a fixed markup of 60%, what I understand is after sales, I'm going to have what is known as cost of sales. So here I'm going to get cost of sales. After my cost of sales, I will get what is known as my gross profit. There you see, gross profit. What I know is if I am making a markup of 60%, when I have bought the goods, they will be on cost. And my cost is therefore 100%. This is my cost, 100%. And then my profit, that's the markup. So here I'll get my 60% markup. You still following me? So that means we can get sales here. What percentage is sales going to be? Definitely 160%. 160%. This is very, very important when you do your statement of comprehensive income. So I have now dealt with this part here. Okay, let's now come. We are told that on 28 February 2023, credit sales, okay, of 9,600 were not recorded. So we have sold goods to a debtor, and these goods have not been recorded. You understand that when we sell goods, it affects how many accounts? 4 accounts. All right. So I'm going to come here and I'm going to have my diskette. I call it my diskette. All right. Debtors, control, sales, cost of sales, and trading stock. Whenever we sell goods, it affects how many accounts? 4 accounts. And then you have to know how to record in these accounts. On your debtors, it's going to be a plus. On your sales, it's going to be a plus. On your cost of sales, it is also going to be a plus. On your trading stock, it's a minus. Okay, I'm going to say that again. Whenever you sell goods and it is not recorded, you consider your diskette. Debtors, control, sales, cost of sales, and trading stock. And then the signs will be plus, 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 minus. All right. And then we know that these goods were sold for how much? 9,600. So here we're going to get our 9,600 here. Still with me? So it simply means then, I'm going to come back to this one later. It simply means when I come here, I need to record that I have sold goods. So I'm going to come here and I'm going to say plus 9,600 for the goods that we sold but had not yet recorded. Have your calculators closed? I need you to punch these figures for me. 1,770,400 minus your 6,000 plus the 9,600. How much do we get? All right, so we end up with 1,774,000. 1,774,000. And then we now need to calculate what is known as cost of sales. So you just ask yourself, what is it that you want? Remember the UK method. The UK method, it simply means you put what you want on top over what you have times what you have to give you what you want. What is it that we want? We want 100%. So I'll come here, then I'll say, I want 100%. What do I have? I have 160%. 160%. And that 160 is equal to the 1,774,000. I put that in bracket. Then I close my bracket. Then once you punch that in your calculators, I want you to tell me, how much are you getting? Thank you. You get 1 million, say it again, 1,108,000. 1,108,000. Is that correct? Yes, 1,108,000. So now we can get gross profit easily. How much is the gross profit? It will become 665,000. 665,000. All right, 665,000. Is that correct? I want you to punch that in your calculators again. Okay, we're saying 1,774,000. 1,774,000. Then you minus 1,108,000. 1,108,000. Okay, that is going to give you how much you get? 666,000. Okay, someone is saying it's 666,000. So yes, 666,000. 666,000, not 65. 666,000. Wonderful. Okay, so I'm going to move on now to the next aspect after I have got my gross profit. Okay, thank you. Let's move on to the next aspect. So we are given another adjustment here, and we're told, all right, remember we've already dealt with this one, and we were now explaining that particular adjustment. Okay, let's see our answer book. There is our answer book. Now, when we came here, we realized that when goods are sold, it affects how many accounts? 4 accounts, you remember. That is your diskette. 4 accounts. That is your debtors control, where you say plus, your sales plus, your cost of sales plus, your trading stock, it's a minus. All right, let's go on. And then we have agreed already that here the goods were for 9,600. So here's 9,600. But we want to know how it affects our trading stock and cost of sales. So we will now say we want to know what is the cost of these goods. Remember, cost is always 100 over what? 160. It's 100 over 160. Multiply that by 9,600. In your calculators, how much do you get? Okay, someone is saying 6,000. Then you get your 6,000. That is what you're going to adjust your 6,000. So we will now come and then we'll now say, once we have sold goods, that must be adjusted on your inventory note, where you have your trading stock here. So I'll come here and then I'll say my trading stock. I have my trading stock here. And in the business records, according to the business records, we have stock of 284,000. This is according to the business records. However, we have sold goods and have not yet adjusted for that. So according to the business records, our inventory must be 284. However, there are some goods that we have sold. Those goods have gone out. We don't have them anymore. So that means we must go and adjust in our inventory. That means we come here, then we say minus. Minus how much? Minus the 6,000. The cost of the goods that we have sold. Then we subtract this 6,000. Are you still with me? All right. And then I just want you to quickly tell me, if you say 284 minus 6,000, how much do you get? All right. So you end up here with something like 278,000. 278,000. Okay. Keep that 278 in mind. Keep that 278 in mind. Then we are told that stock taking. So what happens is that at a particular time, the business will decide to physically count the stock that it has on hand, how much of stock that we have. So the business has done what we call a physical stock taking. So they have amounts on record. This is according to the business records. This is according to the business records. Okay? And then now they have done a physical stock taking. Then they realized that they are having stock to the value of 287,700. Once you have that, that is what you bring here in your inventory note, 287,700. Okay, so we have two figures here now. This is the figure according to the company's records. Remember, we're 284, then we subtracted 6,000. So we now have 278. According to the business records, we must have stock to the value of 278,000. But when we physically counted the stock, we realized that no, man, we don't have 278,000 worth of stock. It is actually 287,700. That simply means physically we have more stock than what we have on record. Therefore, it means we are going to have a trading stock surplus. The other way to ascertain if it's a trading stock surplus, you simply look at the amount that you have here. And then you say, what is the difference between 278,000 and 287,700? And how much is your difference? Your difference is going to be 9,700. 9,700. And that means that difference you're going to add it here. So that when you say 278 plus the 9.7, it gives you 287,700. So that 9.7, since we're adding it, it's a trading stock surplus. To understand what is trading stock surplus, it is when the stock on hand physically is more than the stock according to the business records. Then we have a trading stock surplus. So trading stock surplus is therefore considered other income. I'm going to come here and I'm going to now say trading stock surplus. Trading stock surplus. And on my trading stock surplus, I open my bracket. Remember, I had my 278,000 plus the 9,000. Remember that? But for me to get the 278, I say 284 minus the 6,000. You remember that? Okay. So to make it easy, I'm just going to say the 287,700 here, the 287,700, and then I subtract my 278,000 here minus my 278,000 here. Once I do that, then I'm going to have my 9,700 being my trading stock surplus, which is income. If it was not a surplus, it was going to be a deficit. A deficit simply means the physical stock on hand is less than what is on the business records, Therefore, we end up with a trading stock deficit. But in this case, it was a trading stock surplus. So let's continue with our trading stock surplus. Okay. Then the next one, the next adjustment, are we good? All right, let's continue. Our next adjustment then says, on 28th February, credit sales, remember, we have dealt with this one. A further amount of bad debts of 1.4 must be written. Okay, let's see. I think you have seen now that our adjustments are related. With adjustment number 1, we spoke about the markup. It related with adjustment number 2, which spoke about the goods that were not recorded. And our adjustment number 2 of the goods not recorded related with adjustment number 3, which gave us the physical stock on hand. Okay, so it is very important that you relate these adjustments. And then now you see adjustment number 2 now relates with the adjustment that is to do with bad debts. When an amount is being written off, we consider that to be bad debts. It simply means we cannot recover this amount from the debtor. It could be for a number of reasons. Maybe the business that we sold goods to or the individual has passed on or no longer in existence, or they've been declared insolvent. That means they are not able to pay this particular debt anymore. Once that happens, then we consider that as a bad debt, an expense. So we need to record. So we're going to come first, and we're going to now say, under our operating expenses, we're going to record what is known as bad debts. So I'm coming here, and I'm going to say bad debts. In our list of balances, we have the 7,790. So we come here, 7,790. This is our bad debts. But we're told a further amount, more bad debts to be written. How much? 1,400. So I'm going to come here. I'm going to say plus 1,400. A further bad debt. All right? Then I know that I can close this bracket now, because I now have my total bad debts, which is, calculators ready please, 7,790 plus the 1,400. How much does that give you? That gives you 9,190. This is our bad debts in the statement of comprehensive income. All right. Now, you will then see that once we have bad debts, it affects the note that is called note number 5, that is trade and other receivables. All right. We are given here debtors control. There is one thing that you need to remember, that your statement of comprehensive income will affect some particular notes to what we call the statement of financial position. All right. So I'm going to come here, and I'm now going to have my trade debtors, and I open my bracket therefore, and I say, how much is my debtors control? 88,000. You see that one there? 88,000. And we were told, remember I did the discount with you. Remember that one? The discount. When we sell goods, what do we do here? It's a plus, it's a plus, it's a plus, it's a minus. We are here now. We sold goods of how much? Of 9,600. It was not recorded. That simply means I'll come here and I'll say plus 9,600, because our debtors have increased. We sold goods on credit. Plus 9,600. And then we are told, of the debtors that we are having, we are expecting that a further 1,400 must be written off. A further 1,400 will be written off. What does that mean? It simply means we're going to come and say minus 1,400. A further bad debt. It simply means from the debtors that we have declared some of them unable to pay. So we come and we subtract the 1,400. These calculations are very important. You're going to see when you do the next adjustment. All right. So in here, we've adjusted this adjustment, which affects our debtors, and we have also adjusted this adjustment, the one on bad debts. It affects our statement of comprehensive income as well as our trade and other receivables. Are you ready? We're going to look at the next adjustment. All right, let's go. The next adjustment says, adjust the provision for bad debts to 5% of outstanding debtors. Now, what happens is this. When we sell goods to debtors, there is a chance that some debtors may not pay. This will be based on the trend that we've seen in the previous years, that a particular percentage of the people we have sold goods to on credit end up not paying. So the business will therefore create what is known as a provision for bad debts. It is to reduce our income, all right, saying there is a possibility that some of our debtors may not pay. So now we are being told that we must adjust the provision for bad debts to 5% of the outstanding debtors. Outstanding debtors simply means you should have already adjusted for your bad debts. Okay, so the adjustments that were prior to this adjustment must have been dealt with properly before we get to this particular adjustment. All right, let us see then. We're going to record this in the statement of comprehensive income. But remember what we've done already so far. This is what we just did in the previous calculation. Remember, we took our debtors control, which was 88,000. Here it is. And we had that sales amount that was not recorded. Remember, we added it. Our debtors went up, increased. And then we had an amount of 1,400 where we were told that these debtors have been declared that they will not be able to pay bad debts. So we now have debtors that are able to pay, that is 96,200. Then this is what we call our outstanding debtors. From this particular amount then, we are told to adjust the provision for bad debts to 5%. What does that mean? I'll take my 96,200 then, and then I will now say, of that 96,200, I get my 5%. Multiply by 5 over 100. I'm getting the 5% of the outstanding debtors. Calculators, please. How much do you get? All right, thank you. You get 4,000. Say it again. 4,810. 4,810. All right. So that is my provision for bad debts. Once I have done that, you will find that in your paper, you will get statements or prepositions that say to, and I think maybe in the next class, you see something that says by. Very important. Okay? You hear of to and by. Once you are told to adjust the provision for bad debts to, the figure that you get after calculating, that figure goes to the statement of financial position. All right? So it simply means I'll come here and I will now say provision for bad debts. Provision for bad debts. And the figure that I have is 4,810. So I'll come here, then I'll put it in brackets. That is my 4,810 in brackets. You still with me there? All right. That is what I do there. But I know I have to record something in my statement of comprehensive income. In my statement of comprehensive income, I'm going to try to simplify this. What happened is, last year, we created a provision for bad debts, which was 7,780. We were expecting or anticipating that we were not going to get 7,780 from our debtors. But this year, the new provision is not that high anymore. It is now only 4,810. That simply means we don't expect such a huge amount. Now, the other simplest way to get this is to now say, once your provision for bad debts decreases, once your provision for bad debts decreases, you consider that to be income. But if your provision for bad debts increases, then you consider that an expense. But how do you see an increase and a decrease? This is how you will see. You will say, in the previous year, that is 2022, in 2022, the provision for bad debts was 5,950. This was in the previous year. In this current year, we have calculated now the provision. Remember, we are now in the year 2023. We have calculated our provision to be 4,810. 4,810. There you go. Now, we will now say, what is the difference between these two figures, where we have our 5,950, say 5,950 minus the 4,810 minus the 4,810. How much do you get as a difference? Your difference is 1,140. 1,140, and that is a decrease. Once it is a decrease, we've agreed, it becomes what? Income. So I'm going to come here and I will now say, my provision for bad debts, provision for bad debts, adjustment. All right, adjustment. I will now say, the previous year, it was 5,950, but now it is 4,810. Therefore, it has decreased by 1,140. That is income. That is considered income. The provision for bad debts adjustment. Okay, I think we have done this adjustment, and now we're going to move on to the following adjustment. Are we good? Okay, let's do that. Let's move on to the following adjustment. But before I go, remember what we did. With our provision for bad debts, there's an amount that we record in the statement of comprehensive income, but we considered either an increase or a decrease comparing the previous year versus or against this current year. When it's an increase, it is an expense. When it's a decrease, it is income. And then we know that once we calculate, once we hear that it is 2, the 2 goes to the statement of financial position, which is what we have here. But when we talk of increase, we say increased by or decreased by. So the by amount, if I may say so, the by amount, increased by, decreased by, that is what goes to your statement of comprehensive income. All right, if you're good, just say, give me a thumbs up, then I'll move on. Okay, thank you. Let's go on. All right. The next adjustment then reads, okay, this is on telephone. It says, the telephone account for February 2023, 1,150, has not yet been paid. Remember, at the beginning of this session, we spoke about accruals and prepayments. When an amount has not yet been paid, that amount is owing. That is what we call an accrual. We have incurred the expense, yet it has not yet been paid. So we owe, all right? It is an accrued amount. With our accruals, it is very important that whenever you deal with your accruals, in the statement of comprehensive income, we will add our accruals. We add them because we've already incurred this expense. So we must record it in our books. And that will also be recorded in the statement of financial position. Today, we're just going to leave it for now, but I will only deal with the statement of comprehensive income. Once we have an amount that is owing or accrued, not yet paid, that amount must be added. So I'll come here under my operating expenses. I'm going to take this one. What is that? That is my telephone. And I'll say telephone. I open my bracket. Then I say 10,500. What do I then do? Then I say plus, because it's an accrued expense, plus how much? 1,150. Then I add my 1,150. I get 11,650. That is how I would then complete my statement of comprehensive income on this adjustment. Are we still okay? All right. Good. Let's move on to the next adjustment. The next adjustment is on insurance. Insurance. And it reads, insurance was paid for 1 month in advance. Okay, 1 month in advance. You're beginning to think now, what is this? Insurance is an expense. If we paid 1 month in advance, what are we dealing with? We're dealing with a prepaid expense. You're correct. That's a prepaid expense. Very correct. So we have a prepaid expense, and we're told the insurance premium increased by 10% on the 1st of January 2023. The policy is in place for the entire year. All right, so let's go and see. We know that our financial year is ending on the 28th of February. So if it ends on the 20th of February 2023, when would it have begun? It would have begun on the 1st of March 2022. This is when it began. And then it will end now on the 28th of February 2023. We are then told that we have paid 1 month in advance. That means we extended there now. All right. So we also have paid until March. We've paid until March. So remember, our financial period is how many months? 12. And this March is 1 month. So in total, we've paid for how many months? We've paid for 13 months. Are we okay so far? Okay. So it is the 12 months for the entire financial period plus the 1 month that we have paid extra. Then we are told that the insurance premium was not constant or consistent throughout. It has changed during the financial year. It increased by 10% from the 1st of January. It has gone up by 10% from the 1st of January. So we can't take this amount and divide it by 13 because not all the months were consistent. So we need to be able to see what we were having in certain months. Okay, now we are told that the policy has been in place for the entire financial year. That is good for us. But we're told that it increased when? On the 1st of January. That means when we come to January here, 1st of January 2023, this is when it increased. Are you still with me? So we want to know for how many months was it before it increased? For how many months was it before it increased? We're going to use our fingers then. Okay, let me see your fingers. Let's start. We're going to start from March. So we're going to say March, April, May, June, July, August, September, October, November, December. Do we count January? No, because it's increasing on the 1st of January. So once we have the 1st of January, we then don't count January. We will not count January in this case because it's increasing on the 1st of January. So we've counted and we got 10 months. Here is our 10 months. For these 10 months, it had not increased. So we consider it to be 100%. I'm just going to put the percentage so that you get clear understanding. So for the 10 months, it was 100%. Then how many more months do we have? This becomes easy now because you're counting from what? January, February, the financial year ends. But we paid 1 month in advance. So we get a third month. That is March. So here we have 3 months. For those 3 months, it has increased by 10%. That means it is no longer 100% because it is 100% before any change. We increase it by 10%. So it's 110% then. 110%. So we come here. These 3 months was 110%. Are we still okay? All right, let's go and see. Then we now punch in our calculators. Okay, so for it not to give you problems, you can lose the percentage signs already now. You just say 10 by 100, that gives you 1,000 here. 3 by 110, that gives you your 330. You still following me? Then we add these two figures, we get 1,330. Can I go on? Okay. Once you have your 1,330, then you now say, you want the month. What is it? When we prepaid, March here, is it before or after increase? Definitely it is after increase. So the months after increase are 110. So here you're going to get your 110 over the 1,330. You multiply it by your 107,000 730. Let's punch that in the calculators. I want to know how much we get. How much you get? 8,910. So you get your 8,910. This, therefore, is the insurance premium that we have paid in advance for the month of March. Okay, now remember we're preparing our statement of comprehensive income, and this is a prepaid expense. Prepaid expenses in the statement of comprehensive income, you subtract them. You subtract. So I'm going to come here and I'm going to say insurance. Insurance. I open my bracket. How much do I get? 107,730. All right. Then do I have an amount that has been paid in advance? Yes. So I come in and subtract it, 8,910. And then I'm going to end up now with my amount, which is 98,820. 98,820. Okay. Can I move on to the next one? Let's do that. We're going to move on to the next aspect. And the next aspect then is, here's the next adjustment, rent income. All right. It says, rent income has been received for the period 1 March to 31 December. Okay. We know that if it's from 1 March, it must go all the way to 28 February. Okay, it must go all the way to 28 February, that is the following year, 2023. But here we are told it has been received from March. Okay, it's fine, but we've received it until 31 December. So we come here to 31 December, up to 31 December. Yet it is supposed to be up to 28 February. When we have such a situation, it simply means there is an amount of money that we have not yet received. It's rent income. Remember, it's rent income. That means we have income that we have not yet received. That becomes our accrued income. Accrued income. All right. Now, we are then told that the rent was decreased by 200 rands per month from the 1st of October. So we can't just take the 69,700 and divide it by the number of months till December. That will not work because the rent changed along the way. It decreased by 200 rands per month from the 1st of October. All right. So we know we have received rent with a decrease from October, November, and December. Okay. We do that again. We have received rent that is decreased from October, November, and December. So for these 3 months, rent has decreased by 200. For these 3 months, rent has decreased by 200. That simply means, in total, the decrease that is on this rent is 600. Okay? So it therefore means, if I take the amount that I've received, which is my 69,700, and then I add back this decrease, I say plus, okay, I'm going to add back that decrease, which is how much? 600. Then I say plus the 600, plus the 600. I want you to tell me how much do we get? It's 69,700 plus 600. How much do we get? We get to 70,300. That now is rent for these 10 months from March to December. Okay, for these 10 months, but without any change, So I can take then my 70,300 and I can divide it with these 10 months. Are you still following me? So now I know that rent per month before it decreased was 7,030. That was the rent per month before it went down by 200. Okay, remember it went down in the month of October. So the rent per month before it decreased was 7,030. Then it decreased thereof by 200. It then decreased by 200. It's decreased by 200. How much is the rent after the decrease per month? So it's 7,030 minus 200. That gives you 6,830. 6,830. That is rent per month after decrease. Then Our problem is we received rent until when? Until 31 December. How many months have we not received rent? January, February. How many months are those? 2 months. So we have not yet received rent for 2 months. So we now say 6,830 minus the 2 months. How much does that become? All right, thank you. Someone is saying it's 13,660. 13,660. This is a rent for 2 months. That is after the decrease. The 2 months that is from from January and February. Let's record them there. We come now at the income. It's going to be rent income. It's going to be rent income. Open my bracket, and then I'm going to say 69,700. And then I'm now going to add my accrued amount for the 2 months, which is your 13,660. And then I close my bracket. How much do I then get? I get my 83,360. That becomes my rent eventually. Okay? All right. Let's move on to the next adjustment. Did you understand what we did here? Okay. So first, what we did, we found the rent before it decreased, which was your 7,030. Then we decreased it. And then we found our 13,660 for the 2 months. And then we come and we add it to our rent income because we have not received for January and February. That's accrued income. Accrued income must be added. Very correct. Accrued income is added. Okay, can I move on to the next one? Let's move on to the next adjustment thereof. Okay, it says the loan statement reflected a closing balance of 312,000. Interest capitalized is not yet recorded. So what happens? We have the loan amount according to our business records, which is 294,500. But according to the statement that we've received from the bank, it is now telling us it is 312,000. And we know that the bank charges us interest on the loan that we have borrowed from them. And that loan is being capitalized. In other words, it's being added to the principal loan amount. So what then happens is when they send us a statement, they're now sending us a statement to show us the loan that we're owing together with the interest that has been added in. So in this 312, it includes the loan together with the interest. If I want to know my interest, I'll now say my 312,000, which is what the bank is telling us that we owe them. I then subtract the amount of money that we know we owe them because we have not yet recorded the interest, because the bank gets to calculate the interest. So this is how much we know to be in our business records, and this is what now appears on the bank statement. And then the difference between these two, how much is that? 17,500. Then we now say this 17,500, what is that? That becomes my interest on the loan. So now we have our operating profit. We've completed the entire statement of comprehensive income from the top now. So we are going down. And then we have interest income. Okay, we've added it. Interest income is added. So I add here plus my interest income. Then I get my net profit before interest expense. Then I'm going to come now and subtract my interest expense. How much do we get? 17,500. Then I say minus 17,500. How did I get my 17.5? It was my 312,000 minus my 294,500. That is how I get my 17,500. That should give me then my net profit before tax. How much you get? You're saying 445,000 minus 17.5. That will give you 427,500. 427,500. That becomes your net profit before tax. I think you know what's going to come now. Definitely, we have to look at our income tax. Okay, it then says, income tax for the year is calculated at 30% of net profit. So that means we can get net profit before tax. You see that one there. That one is going to be 100%. That is net profit before tax, 100%. Of this 100%, 30% is my income tax. I'm subtracting it. So that means before I even do anything, here I'm going to get brackets here. Income tax gets to be subtracted. And then after that, I get my net profit after tax. That is 70%. Net profit after tax, 70%. What do I want? I want my income tax. Let's see. If I want my income tax, that simply means I want 30. What do I have? I have 100. Do you see that? I have 100. So it's 30 over 100. Multiply this by 427,500. Just like that. That will give me my income tax here. All right, let's punch that in the figure. How much do you get? Say it again. 128,250. Very correct. 128,250. Then we can get net profit after tax in this case. Are you able to get it? How do you get it? You say 427,500 minus 128,250. That will give you 299,250. That becomes my net profit after tax. Okay, I think we've done this particular question or this particular activity very well. All right, and then now what we're going to do, we're going to do activity 2. All right, so here is our activity 2. But we're just going to take a quick 5-minute break, exactly 5 minutes. I'll be back, and then we're going to continue with activity 2. All right, see you in the next 5 minutes. Welcome back, dear learners. Before the ad break, we did activity number 1. And in activity number 1, we completed the statement of comprehensive income with some exciting adjustments that we dealt with in there. Now we're going to do activity number 2. In activity number 2, I also have some interesting adjustments. Okay, let's look at those adjustments for activity number 2. So we're going to do it exactly the same as we did with activity number 1, where you write and you do the calculations together with me. Okay, let's go. It says you're provided with a pre-adjustment trial balance of Boogley Limited for the year ended 28 February 2023. There was 800,000 shares in issue at the end of the financial year. Required. You must prepare the statement of comprehensive income for the year ended 28 February 2023. Okay, here's our pre-adjustment trial balance as of 28 February 2023. And then here are our adjustments. Okay, let's deal with them one by one. Let's go. The first adjustment reads, the company has 2 directors. Okay, so 2 directors. You remember, directors are employed by the shareholders to do the day-to-day running of the business. Okay, remember, we have executive as well as non-executive directors. Very important for you to know. So the company has 2 directors. They all receive the same monthly remuneration. One director has received his March 2023 fee on 15 February 2023. What does this mean? If the financial year is ending in February, that means it began in March. Therefore, we should have paid our director's fees until February 2023. However, we have also paid it for the month of March 2023. That simply means we have paid for 12 months here and another month here. So we have paid our director's fees in advance for one of the directors. Let's break it down nicely. We know that we're going to show it in the statement of comprehensive income. It's an expense. So we have director number 1. Here's director number 1. With director number 1, he has received his March 2023 fees. That means he has received for his 12 months and one more month in extra. That means this director has received for how many months? For 13 months. So this director has received for 13 months. But this director has received only for 12 months. So we have 2 directors. One has received 13, one has received 12. So if we combine the number of months that we've paid for our directors, they total to 25 months. In total, we've paid 25 months for the 2 directors. Remember, it should have been what? 24 months. So we then say the director's fees that we've paid here is 420,000. That is the director's fees that we've paid. Then we say that 420,000 we divide it by the 25 months. We divide it by the 25 months. And then we will get our 16,800. 16,800, this is the director's fees per month, per director. You getting me? Okay, so this is director's fees per month, per director. So what is our problem? Remember, we have paid for one of the directors in advance. That becomes a prepaid expense. And prepaid expenses, we subtract. Prepaid expenses, we subtract. So I'm going to come here and I'll now say, director's fees. Director's fees. How much do I have here in the list of balances? 420,000. Then we subtract the ones that we have paid in advance, 16,800. Then how much is our director's fees at the end now? 403,200. 403,200. That becomes our director's fees. How did we do this one? We realized that we have 2 directors, director number 1, director number 2. And one of them has been paid more. So we just added the months, we divided by the director's fees that have been paid. We got the director's fees per month, that is our prepaid expense, and then we subtracted it. Adjustment number 2. Okay, let's do adjustment number 2. And it reads, the account of debtor G is only must be written off as irrecoverable When an amount is being written off as irrecoverable, we know that it becomes what? Bad debt. Okay, this is a bad debt. So that means we need to record it in the statement of comprehensive income. So I'm going to come here and I'll say, here is my bad debts. Bad debts. I open my bracket. It is 6,000, and then I'm now going to say, oh, that 6,000 we're adding now. How much are we adding? 1,000. In total, how much is my bad debts? 7,000. My bad debts are 7,000. But if you remember what I told you in activity 1, that whenever you have such an adjustment, it will also affect your trade and other receivables. You're correct. So I'm going to come and I'm going to take my what? My debtors control. I'll come here. Here is my debtors control. And I'll say, on my debtors control, how much is my debtors control? 198,000. Of that 198,000, this G's only will not be able to pay us anymore. So what do? We subtract him from our debtors, minus 1,000. He is no longer part of our debtors. Are you still with me? That is how you would adjust this adjustment. First, in the statement of comprehensive income, there's bad debt. Secondly, under your trade and other receivables. That is note number 5. Are we good? All right, let's move on to the next one. The next one is adjustment number 3, and we want to do adjustment number 4. But let's see how it goes, okay? Do you have a calculator close? All right, let's begin. It reads, Ngobo's credit balance of 2,000 in the debtors ledger must be transferred to his account in the creditors ledger. Okay, what does that even mean? Let's see. Now, we know we're going to prepare the statement of comprehensive income, all right? And after that, once it has to do with debtors, we know it's going to affect your note 5. But for me to explain this adjustment, I want you to come here with me. Okay, we're going to do it here now. We are told that we have Ngobo with a credit balance in the debtors ledger. That means here I'm going to get my debtors ledger. I'm just going to call it my debtors ledger here. Debtor, asset, debit balance, it increases. Plus, minus. Can I go on? It will be transferred to his creditors ledger. That means here I have my creditors ledger. That means credit, it increases. Plus, here it's minus. Are we okay? Okay. Then we are told Ngobo's credit balance of 2,000 in the debtors ledger. In the debtors ledger, we have a balance of 2,000. That is there. Okay? In the debtors ledger, we have a credit balance of 2,000. So we have followed their instruction. It must be transferred to his account in the creditors ledger. When transferring this amount, you simply bring that 2,000 here. We say here 2,000, and we complete double entry by bringing the other 2,000 here. You have another 2,000 there. So we have debited our debtors ledger, and we have credited our creditors ledger. By debiting our debtors ledger, that means we come here and we're saying it's a plus. You can see here, the sign here is a what? It's a plus. So I'm coming here to my debtors, control, my trade, and other receivables. And then what am I saying? I'm coming to say plus. Plus how much? Plus 2,000. So I'm coming here to say plus my 2,000. Plus my 2,000. All right. I have done this adjustment because it affects adjustment number 4. It affects adjustment number 4. All right. We want to see now what is adjustment number 4 say. Adjustment number 4 then says, but you will see that adjustment number 3 did not come into the statement of comprehensive income. No, this is an adjustment for the statement of financial position, but it has an effect on the following adjustment, which goes to the statement of comprehensive income. So you cannot choose adjustments and say, I'm going to leave 3, I'm going to do 4. No, it cannot work like that, because adjustment number 3 has an effect on adjustment number 4, which affects the statement of comprehensive income. Let's see what adjustment number 4 then says. It says, the provision for bad debts must be adjusted to 5% of the good book debtors. Once I hear that, it simply means the examiner is trying to tell me that I must close my bracket here. So I come here, I close my bracket. I have 198 minus 1,000 plus my 2,000. Do I have calculators close? That is going to give me my 199,000. 199,000 over here, because I took my 198, I subtracted 1,000, and then I added 2,000 to get 199,000. Then I am then told that the provision for bad debts will be adjusted to, remember we spoke about the to and the by. Yes, so once I get the 2, I know this comes into my note number 5. So I'll take my 199,000 here, my 199,000, then I multiply that by 5%. You still with me? Okay, how much do you get if you say that multiplied by your 5%? You get your 9,950. You get 9,950. When I have my 9,950, this is the provision for bad debts for this year. So I can come here and I can safely say here, provision for bad debts. I can subtract here 9,950. But I know that when I'm preparing the statement of comprehensive income, I must get, remember what I said, Gilead, you must look for either an increase or a decrease. And we agreed. How do we get the increase or the decrease? Compare the years. We look at the provision for bad debts for the year 2022. This is 2022. In 2022, how much was it? It was 10,050. And then in 2023, we have calculated, we got how much? 9,950. You see that? So we come here, it's your 9,950. You tell me, is it an increase or a decrease? Definitely it is a decrease. A decrease by how much? So you're saying 10,050 minus 9,950. How much is the difference? 100 rands. So you come here, your difference is 100 rands. So you come and say, provision for bad debts adjustments. For bad debt adjustment. Okay, and then I'm going to take my 10,050 minus my 9,950. And then I get my 100 rands. That is how I end it off with. I compare the previous year with this current year, and then that is how I get my provision for bad debts. Okay, I want to move on to the next adjustment if you are ready. Okay, after this adjustment, we're going now to adjustment number 5, which will be our last adjustment for today's class. And the adjustment reads, a physical stock taking on 28 February 2023 revealed the following inventories on hand. You remember what we have said about our physical stock taking, all right? In order for us to get our trading stock surplus or deficit, we know we're going to record it in our statement of comprehensive income, but our inventory note will assist us so much. So we will now say, how much is our trading stock? So I'll come here. How much is our trading stock? Our trading stock, according to the business records, it is 477,500. 477,500. This is the trading stock according to the business records. Let's go on. We are then told that according to the physical stock, our trading stock is 470,000. That means when we did the physical stock, remember I said this earlier on, we only found 470,000, which therefore means we have to come and say minus here. Minus how much? How much do we subtract? 7,500. We subtract 7,500. Once it's a minus, it becomes a trading stock deficit. Once the sign is a minus, it becomes a trading stock deficit. It means if it's a plus, it becomes a trading stock surplus. So I'm going to come into my operating expenses, and I'm going to now say trading stock deficit. I know it is a deficit, and I will have my 477,500 minus my 470,000. and my deficit is 7,500. That is my trading stock deficit. Are we okay? All right. So we have done one part of this particular adjustment where we got our trading stock deficit, and the deficit is 7,500. And then the next one, we have packing materials on hand. But we understand in our nominal accounts, we have packing materials of 11,550. This is what we have incurred as an expense when we acquired our packing materials. So we will come here, then we say packing materials. Packing materials. We have acquired packing materials for 11,550, but we did not use all of them. You will find that at times the adjustment will say packing materials used, but in this case, it's packing materials on hand. So we will come and subtract our on hand, which is 450. We subtract the ones on hand, which is 450. So if we say 11,550 minus our 450, that gives you 11,100. But if the adjustment comes and says packing materials used, then they give you the 11,100. You simply record it here. If it says packing materials used, you record the used amount here. In the last column, we want the amount of packing materials that was used. So we purchased for 11,550, and we still have 450 on hand. That means the used is 11,100. That is on hand. Then the on hand will come down here and it becomes our consumable stores on hand. Consumable, that is consumable stores on hand. Consumable stores on hand. And how much is our consumable stores on hand? 450. That's our consumable stores on hand. Very important. So these are adjustments that you should expect in your exam papers. All right? They will change as our classes continue. We're going to move again to another higher level as we continue. But it is very important that when you attend this class, make sure you bring somewhere to write and then your calculator as well as your pencil. Those are very, very important. And whenever I do particular adjustments, please follow up with me. Punch the figures as I go. So here we did the trading stock and we found a trading stock deficit, which is an expense. The opposite would have given us trading stock surplus. Surplus would have gone to our statement of comprehensive income under other income. And then we also know that if we are packing materials in the nominal account section in the list of balances, we need to know what are we given in the adjustments. In the adjustments, if we're given packing materials on hand, we come and we subtract it on hand to get the used. This here is the used. But if the adjustment comes and says packing materials used, you simply record the final amount, which is the used. Then you can calculate going back again. Very, very important, dear learners. Okay, we have now come to the end of today's class. And I want to thank you for joining me today. We're going to meet again next week, same time, same place. And remember what you bring: paper, somewhere to write on, pencil, a pen, and a calculator. Of course, I'll need you also in my class. So I have to see you next week, same time, same place. From me, it is goodbye.